Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. In today's video we need to talk about Alibaba stock because this is a company that I've been talking about recently on my channel and it's just been incredibly volatile and unstable. There's been a ton of negative news that I believe is FUD or fear, uncertainty, and doubt coming out around Chinese stocks in general lately. So we need to talk about all of the news and my thoughts and my research and my thoughts on everything surrounding China right now. I'm sure we all know Alibaba stock has been selling off like crazy and it hit about $186 a share just some days ago. People are selling the stock now because they don't want to own it at all anymore. I do not believe that people are focusing on the fundamentals of the business, so as a long-term investor, your main question should be, is all of this selling warranted or is it providing long-term investors with an opportunity? To answer this question, let's start with all of the negative news surrounding Chinese stocks right now. An article from the New York Times says Chinese regulators barred tutoring companies from making profits, a move that sent shares plummeting on Monday, erasing tens of billions of dollars from the value of the country's once blistering education sector, as Beijing turns its focus to the growing financial burden that students and their parents face. So from this article, which I will link below, we can see that Chinese have basically forced their private tutoring companies to stop making profits. They're now non-profit businesses, and public companies like TAL Education dropped massively by over 75% on the news. The fact that China essentially forced an entire industry to stop making profits is scaring investors, and to believe that the government could do something similar to the major tech companies like Alibaba and Tencent. So the question is, what was China's incentive to just stop an entire online education industry from making profits? I believe that this article from Reuters on the cost of having a child in China helps explain this. In this article it says the cost of raising a child in urban China has deterred many would-be parents, and China's fertility rate has fallen to just 1.3 children per woman, despite Beijing's scrapping of the one-child policy in 2016. Competition is so fierce that a popular term in parenting circles, jiwa, or chicken baby, refers to parents pumping energy-boosting chicken blood into their kids by loading them up with extracurricular classes. In order to ease pressure on children and boost birth rates by lowering family education costs, China has launched a clampdown on the country's booming private tutoring industry. According to a 2019 Shanghai Academy of Social Sciences report, an average family living in Shanghai's upscale Jiang district spends almost 840,000 yuan per child from birth through their junior high school, which typically ends at age 15, including 510,000 on education alone. Low-income families in Shanghai's Jiang and Minhang districts, which have annual incomes of over 50,000 yuan, spend over 70% of earnings on one child, the report said. I will link to the article in the description below if you'd like to read on. It's clear that China is trying to increase their population, but the cost of having a child is deterring people from having kids. The education sector in China has become so expensive that families literally cannot afford to have two children, and this is driven by private tutoring industry. 70% of low-income families' incomes goes to paying for education. So how could they afford to have another child when over half of their income goes into education for just one? The average family also spends 840,000 yuan, which is equivalent to about 130,000 USD, through junior high school on education alone. So China is forcing these tutoring companies, profiting off of all of this, to become non-profits now, so that families can afford schooling and save more money and ultimately afford to have more children. This is China's incentive for the online education companies. The next question to ask would be, will making education companies non-profit harm Alibaba in any significant way? Alibaba does in fact have just a few investments in the space, namely Zhu Yimeng back at the end of 2020, although Alibaba's investment isn't known. The total investment round was $1.6 billion, which was pulled together from multiple companies. Let's say that if Alibaba funded its entire $1.6 billion investment in their own and an investment turned out to be a total loss, it would hardly harm the company at all because Alibaba currently has about $49 billion in cash on their balance sheet. So it seems that Alibaba has little exposure to the Chinese education sector. Another piece of negative news that came out is that China wants Tencent to give up exclusive listening and copyrights. They were also fined $77,145, which isn't very significant, but it's still worth mentioning because it shows China is continuing to step in with their companies. This is all just another case of China clamping down on their big tech companies, and Alibaba isn't directly affected in this most recent news with Tencent, but Tencent has dropped massively on it, and Chinese stock kind of trade in line with each other to an extent. In fact, a state-owned Chinese newspaper criticized online gaming as opium for the mind, so Tencent said it would introduce new rules, starting with its flagship Honor of Kings game, that will enforce tougher limits on playing time than required by the authorities. Young gamers will be limited to playing for an hour on weekdays and 2 hours on weekends and holidays, and children under 12 can't make in-game purchases. So what are your thoughts as a value investor? The CCP is definitely a wildcard factor when investing in China, and they do impose some level of risk. However, it does seem like it's not in China's best interest to continue cracking down so hard on their companies, since it will deter foreign investment into their country and into their economy. The yuan has been falling on all of these clampdowns and regulations, which means China's currency is becoming less valuable on the global stage. Chinese bonds are also falling, and they have been falling since December 2020, when the China fear started entering the stock market. The Chinese bonds falling and their currency losing value suggests that investors are leaving the Chinese economy and pulling their money out of the country, which is not in China's best interest, as it lowers their economy's growth and their stance on the global stage. Because of this, China's state media has been trying to reassure investors. This article from Shanghai Securities News, which is owned by the official Xinhua news agency, which will be linked below, says that nearly $600 billion in value was wiped off the Chinese stock market, and further down it also says the panic sell-off provides an opportunity to buy on dips, meaning to invest in stocks that have plummeted in price, as there are no fundamental changes to the onshore market. This is according to an article published by the Securities Times, which is run by the Communist Party mouthpiece, the People's Daily. The Shanghai Security News, which is owned by the official Xinhua news agency, ran an article saying there's no systematic risk and that stock valuations are expected to rebound. The Securities Daily cited analysts as saying the turbulence was simply a result of funds rotating in and out of sectors, and reassured readers that the big picture of the economy and liquidity remained intact. So Chinese news outlets are saying the fundamentals remain intact, and they're expecting a rebound in stocks, and these news outlets are apparently owned by the state media. It looks like China is trying to regain investor confidence and assure them that the fundamentals of the market do in fact remain intact. It doesn't seem likely that China wants to completely ruin the fundamentals of their own market or their best businesses. As value investors, let's look at the fundamentals of Alibaba. On their income statement, China produced 370 billion yuan in revenue in 2019, and by 2021, just 2 years later, this nearly doubled to 717 billion yuan. This is equivalent to about $109 billion in US. Their net income was also $21.8 billion for 2021. So Alibaba is in fact producing tens of billions of dollars in profits annually. Next onto the balance sheet, Alibaba has $49 billion in cash, $98 billion in current assets, and total assets of $275 billion. So Alibaba is very cash rich and has hundreds of billions of dollars of assets on the balance sheet. However, assets aren't everything, and so we need to look at the liabilities. Alibaba's current liabilities are sitting at $57 billion, which is just over the cash position the company is currently sitting on. The total liabilities are sitting at $92 billion, which is less than the $98 billion in current assets the company has. This shows that Alibaba has a very strong balance sheet, especially when we factor in their business is producing billions of dollars in cash annually. And finally, let's move on to their cash flow statement. Their cash flow statement reveals that Alibaba produced $35 billion in cash from operations in 2021. Let's see how the company is spending the cash that they produce from their operations. So where is this money actually going? So if we take a look at their investing activities, we can see that they spent $17 billion on increasing their short-term investments, $8.7 billion on acquisitions of securities and other investments, and $6.3 billion on property, plant, and equipment. So to me, it looks like the majority of Alibaba's cash from operations is going right back into investing in growth or just investing in investments, which I think is awesome to see. Let's find the free cash flow from their business. The free cash flow is calculated by taking the cash from the operations and subtracting the investments in property, plant, and equipment. Free cash flow equals cash from operations, property, plant, and equipment. So Alibaba had $35.378 billion in cash from the operations and $6.326 billion in property, plant, and equipment expenses. This ultimately means that Alibaba produced about $29 billion in free cash flow in their fiscal 2021 year. Alibaba's market cap also sits at $528 billion. So if we take the market cap and then divide it by the free cash flow, we will get Alibaba's price to free cash flow. 528 billion market cap divided by 29 billion FCF equals 18.2. We can see that Alibaba is currently trading for an 18.2 price to free cash flow. This is a very low ratio for a business that is growing revenues and fundamentals as quickly as Alibaba. It's possible to believe that Alibaba will continue seeing amazing growth because China is projected to become the largest economy in the world within the next decade. They're actually projected to overtake the US economy around 2028. Now, we can see that the Chinese economy still managed to grow through 2020, whereas the US saw quite a decline in their GDP. The growth of China is real, and it looks like it's not going to slow down anytime soon. Alibaba, in my opinion, is one of the best companies out there to gain exposure to China and all of its growth, and I think that Alibaba will see growth alongside China for decades to come. On top of this, Alibaba recently increased its share repurchase program from $6 billion to $10 billion by the end of 2022. This suggests that the business returns cash to shareholders, and if the fundamentals of the business remain intact, then share repurchasing can continue to grow with the company. Also, if Alibaba shares continue falling at the same time as the business is buying back shares, then that is an awesome recipe to continue lowering the company's earnings per share because they're going to be buying even more shares off of the stock market. As value investors, it seems like Alibaba is one of the best ways to gain exposure to the Chinese economy and all of its growth. The underlying fundamentals are growing very nicely, and the business is now returning some of their cash flow back to shareholders through these shares repurchased. From the research, it doesn't seem likely that the Chinese government will do anything to completely derail some of their best companies because it makes investor money leave their economy, as we saw with the Chinese bonds and with their currency falling. Let's remember the quote from Warren Buffett that says, "Be fearful when others are greedy, and be greedy when others are fearful." Please make sure to subscribe to my channel if you want to stick around, and I really hope that you all enjoyed this video. Thank you so much for watching, and if you like this video, please share it with your friends and family. It'll help the channel a lot. Leave in the comments section your thoughts about this video and what I should cover next. With that said, thank you guys so much for watching this video, and I'll see you in the next one.